Thank you very much, and thank you very much, ladies and gentlemen, and to Terrapin also for inviting me back. I think this is the 8th or 9th year. I don't have the charisma of Robert and the sort of game show host style of chairing, but hopefully we'll have a different approach, because traditionally I was an accountant, so I'm probably a little bit more boring than Robert. So if we can have my slides up. This afternoon we're going to talk about new revenue streams. Last year we talked about that and looked at a lot of the price elasticity of demand and the friction between the different market types, the new markets and the traditional exchange-driven markets. And now this year what we've got is 6 sessions after my very short introduction on some new product developments and innovation in the different areas, covering the cash markets all the way through to exchange-traded derivatives. So what I would like to briefly talk about, on the website you'll see our list of clients, which is about 100 clients across the world, is I just want to recap briefly, because it's always useful to remind ourselves of why all the exchange industry exists. And it was actually interesting to hear David write this morning, refocus on some of the key issues that have affected the industry in the last 5 years following the crisis. Then look at, and I'm going to use a case study from Europe about where all the volume has gone, or where has it gone, and then evaluate whether the legal and regulatory change that's on the horizon and in some cases being implemented now is adequate to do the job to recover all the volume and give the industry the confidence to actually grow. And then in terms of where to next, I'm not going to go through what potential options there are for different markets in terms of new revenue streams. That's where all the case studies are from this afternoon that we will look at. So historically, before the demutualization fashion came in the late 90s, the key objectives of exchanges were essentially very closely to the development of an economy. So the exchange was there basically to fuel economic development. It was a key engine of economic development. Often in many countries, and even in the UK, for example, it had policy goals, the exchange, in terms of economic development. And what that meant was basically mobilizing domestic savings and institutional investment into the capital markets, something that David Wright mentioned that we need to be able to recover, because essentially the IPO market has significantly reduced over the last 3 to 5 years. And then once the primary market was created, then the exchange was in charge of the price formation in secondary market trading, and that is very much a public good, or was traditionally a public good. So, and if you look at Wikipedia or other economic sources on what is a public good, it's basically something that an economy needs but is essentially free. But man, unfortunately, has this uncanny knack of ruining public goods. So air, for example, gets polluted, and then they have to bring in emission controls to improve the quality of air, and which is why there is now, for example, less smog, etc. in Europe, but there is still a lot in developing in other parts of the world. And the same is now beginning to happen with the price formation process with exchanges. You're seeing all of the regulation coming along, broadly attacking HFTs, saying which is what David basically said this morning, that regulators are extremely concerned about what HFTs are doing to the quality of the market. And as I said, the exchanges had a big public policy role, especially where they were the vertically integrated markets, and they were in charge of clearing and settlement. So they had a big role in the legal finality of settlement, and also in the novation and clearing process. But then, the 21st century came along, and everyone thought competition was a fantastic idea, and it is a great idea. It's the best model of economic development that the world has come up with so far. But has it gone too far, or has it gone without sufficient regulation? And now most of the exchanges around the world are simply there to maximize the wealth of shareholders without necessarily sufficient concern for the quality of the public good and the price formation process and the mobilization of wealth into the capital markets. And that's demonstrated by the figures. So if we look at the European equity market volumes, if we compare, the source of this is the FESE, Federation of European Stock Exchanges. If we look at the European lit order book volumes, what you can see is that for the exchanges, trade volumes are down, turnover is down, and the average size of the trade is down. And similarly between 11 and 12 for MTFs, except on the trade side, the trade volumes are up on the MTFs, but as everyone knows, that do the MTFs really contribute to price formation? They use price formation from the main mature reference markets, but when those reference markets are down, the MTFs are not really able to price form. So during the day, they're good hedging mechanism, arbitrage, etc., but they need a reference. And also, because they're like low-cost airlines, they've really lowered the cost of trading, taken away market share or grabbed a new level of market share, but actually they're not yet profitable businesses. It's interesting to note that in Europe, I think there's 100 or in excess of 140 licensed MTFs, and there's less than 5 profitable ones. So, it's a great idea in terms of competition, but is it the right thing, recognizing the objectives of capital markets? And the same applies in the dark order space, the dark order book space. So there's been a small increase in volumes in the last year. The average trade size is down quite significantly, with relatively low trade sizes in the MTF space. And then if we look at the other sides of this, which is the off-electronic order book trading and the trade reporting side of it, again, all that volume is down, even though except that the average trade size has gone up in terms of exchanges. And in terms of reporting, there's a slight increase from the exchanges side, but the average trade size is going down. This kind of suggests that there's more move to opacity of the market, so yet less use of the order book. And is that because the trade sizes are getting smaller and smaller? Long-term investors cannot necessarily use the order book as a reliable source. They need to use the banks who put capital behind them. Banks haven't got so much capital these days. And so the structure has changed, and the competition that's been brought into the marketplace has fundamentally changed the structure, but not necessarily always for the good. And then the ultimate impact on all of this, and in particular the crisis, is that the primary markets, and the source of this is from the World Federation of Exchanges, has dropped considerably. I mean, less than, in Europe, this is just purely for the European market, 50% of the level of issuance compared to 2007. Now, you could say that 2007 was not the norm. It was a peak, a freak, but still the confidence is not there to get back to the higher levels of issuance that basically economic blocs need in order to promote economic development. Now, what are some of the reasons for all of this? And categorized it into 2 broad areas. Basically, there are 2 C's in terms of confidence and competition. And in terms of confidence, essentially there's been a significant drop in confidence, and therefore long-term investment has retreated out of equity markets into other instruments, and that's what we're going to hear about a lot this afternoon with these other new product initiatives that are going on. And also, the level of competition is so high, and there is a lack of a level playing field, as David discussed. So, exchanges, MTFs, and bank internalization engines are simply not today on the same playing field. They operate with different levels of transparency and under different rules. So some of the volume has disappeared into the banks. and then the rest is between the, or is just stopped. Maybe long-term investment is not trading. And in terms of market quality concerns, the high level of slicing of transactions down to, you saw the average trade size is now down to, in the lit space, 7,000 euros, just over 7,000 euros, just makes it very, very difficult for long-term investment. So it's not necessarily the most fantastic idea to have achieved that result. There are a few exceptions. Some of the markets in Europe have still managed to maintain slightly higher trade sizes, but in the main it has got too low. And then the whole issue of speed, the markets are now effectively on steroids with the drive to lower and lower latency. And we know what happens with steroids if you look at other industries like the cycling industry and Lance Armstrong. I mean, it's interesting to note in that space, an Australian library has now moved all his books to the fiction area. So, applying steroids to the business may not be the best idea, but equally, some of the new rules that are being proposed to control them are equally not some of the best ideas in town. And that's also tied together with the spoofing. And then I think the whole issue of surveillance is just not well thought through at all. Surveillance is now caught up in a whole area of competition. It isn't a level playing field. The exchanges do a much higher level of surveillance than other alternative platforms, and they also have the relationship with issuers. But unfortunately, they can't control or get access to the data as was discussed in the first session this morning with Hans Ola. And really, perhaps surveillance should be decommercialized and depoliticized and moved solely into the area of the regulator, such that actually investor protection can improve. But unless the industry addresses these issues, the level of confidence is not going to go up, and the level of issuance is not going to go up. And it's perhaps worth looking at some of the other developments that are going on in other markets, like, say, Brazil or others, where a much higher level of control is put in place, and as a result is seeing the benefits in terms of issuance and trading. So a lot of issues associated with competition and the impact it has created in the capital markets and the exchange markets. So the regulators have reacted, and there's this whole range of legislation, and we're going to cover some of this later. I don't propose to go through it. The whole goal of all of this legislation is to improve confidence. Whether it will actually achieve it remains to be seen. What it will do is take some of the stimulant out of the industry in terms of bank capital, etc. And therefore it should drive for better business decisions. It should also increase transparency, level the playing field in terms of the different venue types, which will then mean there should be a higher level of investor protection. But it remains to be seen over the next 3 to 5 years whether the innovation will still overcome this, because there still isn't probably adequate threats in the market from the regulators to ensure that there's a balance between greed and fear, which is probably missing today. So with that brief introduction, what I'd like to do is, in terms of where to next, we're going to go through the different case studies, and I'd like to introduce Sergio Ricardo Liporaci Gula, who's the Chief EU Representative from BMF Bovespa, based here in London. He's going to talk us through 4 or 5 different product types that Bovespa is introducing, and explain how the markets are overcoming some of these challenges in the Brazilian context, and they're looking at it very much from a global point of view. So thank you very much.